Good morning, everyone. Thank you for joining us today for our webinar, Achieving Your Business Goals with Financial Planning, hosted by Armanino and Jirav. My name is Naila Isa, and I'm on the marketing team here at Armanino. I'd like to go through a couple of housekeeping items before we get started. You can maximize or minimize the webinar pane during the presentation by using the red, orange arrow buttons in the upper left corner. During the webinar, we also encourage you to ask questions. In the webinar pane, you'll see a questions box that you can use to type your question and click submit. Our presenters will answer those questions as time permits or at the end of the session. Second, for good audio quality, please check your setting to ensure the appropriate audio option is selected. Or if you're listening through your computer, then please click on the computer audio option. As a participant, you will receive a link to the presentation and recording within 48 hours. We have a great session planned for you today. Our panelists will be discussing finance's main jobs, the financial planning and analysis cycle, reporting analysis, and forecasting, and how it all comes together. I'm going to hand it off to our panelists who will introduce themselves.
Thank you so much, Nyla. My name is Blake Oliver. I am a CPA, and I am a marketing director here at Giraffe. I am so happy to be presenting with Armanino and with John and Evan today because I am an Armanino alum. I worked in the West LA office at Armanino as a manager in the client accounting services practice, where we dealt with a lot of the challenges of clients who wanted to get a forward look at what's going to happen with their businesses. And it's one of the reasons that I ended up joining Giraffe after I worked at Armanino was we needed a better way to do budgeting and forecasting outside of spreadsheets. And I'm really excited that Armanino is partnering with Giraffe now in order to deliver forward-looking advisory type services to clients. I'm a CPA. Like I said, I have a lot of experience in the client accounting services world. You might know that as bookkeeping. I was a music major in college at Northwestern. I played the cello. Got my start in accounting doing bookkeeping because I graduated into the financial crisis and needed a job. And it's kind of amazing. By luck, I found something that I really am passionate about and I enjoy. So happy to be here. Happy to be with Armanino and John and Evan today. Evan, will you tell us a little bit about yourself?
Sure. Thanks, Blake. Good morning and good afternoon, everyone, depending on your time zone. My name is Evan Wells. I'm the Vice President of Business Operations and Financial Services here at Giraffe. My journey into Giraffe actually started as a customer. I was one of the early customers, 5 years ago now at this point. I've had an extensive career that started out in Big Four public accounting, and I've gone into industry since, and I've been in the startup world for a number of years now, and really enjoy working with startups and helping understand how to get their business goals achieved. And so looking forward to sharing with you what we have here today. John?
Great, thanks, Blake. And Evan, John Cogan here. I lead the strategic finance outsourcing organization at Armanino. By way of background, I started my career in corporate finance at very large companies, Allied Signal, Cisco Systems. And then I became CFO of a number of growth companies and eventually CEO of a few. So I've seen all stages of corporate growth and been right in the thick of growing companies and using the art and science of finance to help with that growth, help companies get where they're trying to go, whether that's some sort of direct exit or sustained profitability or whatever it may be. So excited to be on the call today with our friends at Giraffe to talk a bit more about using the tools of finance to help entities get where they're trying to go.
Thanks, Evan. Thanks, John. You might be wondering, why a giraffe? Why did we name our company a misspelling of this word? You can just say giraffe, by the way. We try to make it easy for you with that. The reason that we chose the giraffe as our mascot is that it is the tallest land animal in the world, and therefore it has an amazing view of not only where it's been, but where it's going. And that's our goal as a company, is to give you and your business a better view, not only of what happened, but also what is going to happen. Figure out, how do you get where you want to go? We are a team of about 50 at this point, a venture-backed software as a service company building financial planning and analysis tools for small and medium-sized businesses, which up until now really have not had options in this space other than spreadsheets, which, as we all know, get very cumbersome and difficult to manage when you're doing forecasting and budgeting. We were founded in 2015 by a finance director, Martin Zich, who was doing all of this stuff in spreadsheets and wanted to figure out a better way. And we're spread out across the world. We have offices in San Francisco, Seattle, Austin, and a bunch of development going on in Torun, Poland. So with that, I'm going to hand it over to John to talk about Armanino.
Thanks. In brief, Armanino, actually, with our latest growth, we're now a top 20 CPA audit, tax, and consulting firm. Nationally, we're at about 2,000 employees with folks in most states, clients in all. Our purpose is to make a positive impact on the lives of our clients, people, and communities. And we do that every day by, working arm in arm with our clients to help them figure out how to reach their goals and help them get there. So very happy to be here today.
So John, I think you are going to lay the groundwork for us here because we're talking about how we can achieve business objectives, right? And
yep.
Accounting, traditionally, we tend to look backward. You have this analogy of the rear view perspective. Would you explain to us what that means when it comes to accounting and finance and how we can do better?
Sure. Well, with no offense at all to our good friends in accounting, accounting tends to be about historic record keeping, which is incredibly valuable, but it does focus on what's happened. Revenue, expenses, transactions that have occurred. That is the domain of accounting. And some people liken that to, if you're running a company and you only have accounting, well, you're driving using the rear view mirror. And in fact, there's some value there. You can, even in the rear view mirror, you can usually see if you're in your lane and are there cars around you and where did you just come from. There's great value to that. And it's hard to understand your future without having a great understanding of your past. But it is only a small part of the view of a driver. And if you'll go ahead and click the next slide here, this is the view that is where you're going. And most companies are here to get somewhere. Now, that doesn't always mean an exit per se. So not every company is trying to get to an IPO or M&A. Some companies are just trying to survive or drive more cash out of their operations or build more sustained profitability and go long. And that's great. And that's all front windshield stuff primarily. So if we're leveraging our rear view mirror, which absolutely has value, but then how do we play things into the future so that we can understand where we're trying to get? And we're going to spend the rest of today's conversation really focused primarily on the front view. Now there will be some talk about reporting, which is inherently a backwards-looking thing. But let's get into finance. And when we say finance separately from accounting, what are we talking about? And I like to say that finance has two primary reasons for existing. Number one is understanding a company's core economics so that they can constantly be improved. All right, so that's two pieces to number one. And we're going to get into details on this, but what we call advanced reporting or beyond GAAP or beyond accounting-based reporting, that's what we refer to as advanced reporting. It gives you insight into the numbers. So you're not just seeing numbers, but you're getting a sense of the why and how. And then financial analysis is when you dive deeply in to try and figure out, well, what's going on here, or what's causing our economics to be what they are. And I'm not going to steal our thunder, so we'll have examples and some discussion about that. So understanding your economics, that's number one. Number two is helping an entity get where it's going. So for for-profit companies, it could be some sort of exit or profitability. For not-for-profit companies, it could be more successfully achieving the mission or impacting more people. Everyone has a need for both of these things if you want to be making the most of the entity that you're running, the dollars that you have, and making the greatest impact. And the job of finance is to empower leadership with actionable insight and data so they can run the entity.
So accounting is the rear view mirror. It's where we've been. Finance is looking through the windshield. It's where we want to go. We need to do both. But if all we're doing right now is looking through the rear view mirror, it begs the question, how do we turn around? How do we start looking through the windshield? And this financial analytics maturity model gives us a path to do that if we are not yet adding the finance function into our business. And the way this model works is at the bottom left, we start with the least difficult, lowest value type of activities. And this is traditionally bookkeeping, descriptive analytics, describing what happened, bookkeeping, accounting, that's looking through the rear view mirror. As we move up and to the right on this chart, we start to turn around and we start to look through the windshield. So we might start adding in diagnostic analytics into our reporting. That could mean creating visual dashboards for management, for executives, tracking KPIs, reporting on those. Maybe we add in some non-financial metrics into our reporting and we combine them. So we're suddenly tracking lead flow, or perhaps we're tracking widgets produced or revenue per operations employee, that kind of thing. That starts to help us understand why things happen, not just what happened. Then as we get into these top two stages, that's where we really start to look forward. So we start to ask what will happen with predictive analytics. That's where we're being more of an analyst, and some of the activities in the third stage include forecasting. And finally, the most difficult thing for a small business, small or medium-sized business, is answering the question, how do we make it happen? That's where we're performing a CFO type service, prescriptive analytics, meaning to write before, to really figure out how do we get there. And that could be budgeting, forecasting, but as we'll see, it really takes a holistic approach to financial planning and analysis to achieve that level of maturity in financial analytics. So I present this here because it's really good to understand where you're at with what you're doing right now in your accounting and finance team, and then figuring out how we can get to the next level. Because again, suddenly turning around and looking through the windshield can be overwhelming. And that's what we're going to talk about now, is this holistic FP&A process, and then what exactly goes into that. Like what are the different activities we're doing in a financial planning and analysis cycle. So this is a model that we've developed here at Giraffe in partnership with Armanino. And again, it's really important. You can't just do forecasting or budgeting or reporting or dashboarding in isolation and expect to get results. You really need to do them all together. So let's start at the beginning. The core of FP&A is long-range planning. And that often means a 2 to 5 year forecast, but it's a lot more than that. And Evan, you have done a lot of long range planning in your time with various startups, growth companies. It's very important. If you don't have a long range plan, it's kind of hard to raise money from investors, right? So that's one of the reasons it's very important in the Bay Area startup world. So I wonder if you could give us an overview of, like how you think about long range planning, what that encompasses, what's important to think about.
Sure, thanks, Blake. Yeah, I would say when you're thinking about long-range planning, especially when you're making a lot of decisions in the business on a day-to-day basis, those day-to-day decisions can impact your long-range planning and have a completely different outcome than what you had originally thought. And then so by thinking about the long-range planning, it starts to inform your short-term decisions to make sure the decisions you're making today align with the long-term interests of ultimately, an exit for the investors from a venture capital point of view. You want to make sure that you have a pathway to profitability, that the what you're doing today makes sense in 3, 4, 5 years from now, and you're able to align all the resources that you've brought into the company, because the number one resource every early stage company has is human resources. And so you have to make sure all those human resources are aligned around a long-term strategic vision. And if that long-term strategic vision changes over time, you need to make sure that everybody agrees to that alignment and are swimming in the same direction so that you can provide that outcome that you're looking for. Doesn't mean that the long-range plan has to be perfect, just means that everybody has to be sort of shooting at the same goal. And so by having that process and that mechanism to align those interests across competing priorities is very critical in terms of understanding how to operationalize your next 3, 6, 9, 12 months. But in order to really understand what your next 4 quarters look like, you really got to think about, what does the business look like at scale? What does it look like at 5 years? And does it make sense for what we're doing today in order to deliver that outcome?
How about you, John? How do you think about the long range plan and specifically, I guess, forecasting, because that's a really important part of it.
Yeah, so it's interesting. The first bullet on this page says, see the future without having to live it. I love that because if you're not planning for the future, then life just happens to you. And this is what happens in a business. And we see it all the time, where companies are running on the guts of founders or not-for-profits, on the guts of their organizers. And things just happen. And there isn't a sense of, well, how are we going to grow or be more profitable or serve more of our constituency? It just happens. And it's a scary thing to look into the future. But when you do that, you realize that you can actually impact the future, as Evan was just saying. It's incredibly important, and there are all sorts of studies about people who write down their goals, or have a higher probability of achieving those goals. The same goes for business, but I think for some slightly different reasons. Business, whether it's for-profit, not-for-profit, etc., they're so complex that it's impossible to keep it all in your brain, make the right moves, rally everyone around what you're seeing or thinking, unless you've written it down. And the forecast is a wonderful mechanism for rallying everyone. First off, a good forecast starts with a good corporate strategy. And that tells us, oh, well, what are we trying to do here? And then you go from that strategy to, this list and 100 times more, which is, okay, well, to achieve that strategy, what are the things we're going to invest in? And basically, your forecast is about investment. Every month, you're investing in salaries for your people, or you're investing in go-to-market activities, sales and marketing, et cetera, investing in operations. So there's, just an unimaginable amount of action that should flow out of a plan, which really is the forecast. And when the organization comes together around the forecast, you're aligning everyone around that, and then backing all of that alignment with investment and hard plans like, oh, next quarter we need to close X deals at Y dollars to drive Z revenue. And all of that comes together much more easily with a forecast. Without it, it's really hard. And we basically, unless folks are, ships in a rising tide, which is fortunate, it's a lucky place to be, but even those folks aren't optimizing their outcomes. It's really just so incredibly important to have this written down, understood, and then try to live it.
So we know it's important. I think like we all want to be doing a long range plan and do the forecasting, but a lot of times in businesses, unless something forces us to do it, we don't. Like, why do you guys think that it just doesn't happen as much as it should?
Well, I'll tell you from my experience, and of course, we're talking with company leaders constantly here. There's the tools of finance are not as well understood by folks as accounting and bookkeeping. Like everyone, I think, who has anything to do with business just inherently understands, oh, when I spend money, someone has to account for that, and it's going to show up on, my P&L at the end of the month, or when I, earn revenue, that's going to show up there. I think that's actually maybe an easier concept because it's so universal. Nobody doesn't run a company, or shouldn't, without at least some basic accounting. Interestingly, finance is done by every company on earth at scale. Like all of the companies that have made it have figured out they literally can't make a move without finance. And you go to the Cisco's and Cardinal Healths and Walmarts of the world, and they just have armies of finance people because, like we said a couple slides ago, you can see the future without having to live it. Like, what kind of gift is that? But small companies are resource constrained, and frequently the folks who are running those smaller entities, for profit or not for profit, aren't as familiar with utilizing the tools of finance, and therefore it's seen as a luxury, or perhaps not quite fully understood, which is understandable if you haven't lived through that. So I think there's maybe a bit of an understanding gap there, which is part of why we're here today.
Yeah, and I would add on, Blake, that especially for specifically on venture-backed early stage small business companies, technology companies specifically, it's almost kind of built into the market that you're only given 18 months of runway by venture funds. So you're always only looking at the short term of the next round of financing. And then if you go into the public markets, to what John was just referring to, it's all about EPS guidance. So if you look at sort of just how we as practitioners in the profession, we're sort of purpose built to think in this sort of short-term sort of frame of reference, but the finance leader's job is to take leadership, and to take leadership, you need to start thinking about that long-range planning and those decisions that come up in the short term and how they impact the long term. So it's a delicate balance, shifting from the backwards looking to the forwards looking, for sure.
So Evan, as somebody who's lived it, you have a very good idea of what this process looks like. Can you give us an idea of, like, if let's say I'm a business owner and I've got, I don't know, a business doing $50 million a year in revenue. We've got some like manufacturing operations. We've got a few different locations or something. What, when should I start this process? What would it look like?
The moment you start manufacturing, especially if you're only operating in the world of accounting, without a forecast, you could get inventory out of control, which is, in my view, one of the number one reasons a controller loses their job, is because you tie up too much working capital. You need to be able to forecast and measure against that. Your purchase order quantities into the distance are not going to exceed what your cash flow looks like, so you have a cash cycle to worry about. So when you start thinking about forecasting, you're not only thinking about, are we hitting goals and objectives, you're also thinking about, is the business going to be able to operate? Are we going to have a cash shortage in 6 months due to purchase constraints, and if we miss our revenue forecast by this amount? And so that's anytime when you start making working capital decisions, that's definitely the moment to start thinking about financial forecasting.
So it sounds like, kind of, regardless of what business it is, a lot of forecasting starts with cash, working capital, because that's the thing we have to conserve, or we don't survive as a business, right? And then, when it comes to what the forecast actually looks like, how do you approach it, right? It can seem kind of just, it's hard to visualize if I'm not a finance person, and I'm not, right? I come from the accounting world. Like, how do you build this thing? 'Cause I've seen some really complicated models.
Well, of course, I mean, everything's going to start. So I'll share a story, because we all like stories. So I once was helping advise a company because the investor who had invested into the company said that the CEO, who was extremely smart and could do a lot of number crunching in their mind, but the point of a financial forecast and financials is a communication tool to show others what your thought process is, and so people can analyze that information. And this specific individual had literally taken a screenshot of their bank balance and sent it to the investor and said, "That's my forecast." Yeah, that's not acceptable, right? So, what you got to start with is, okay, what you have headcount, right? I mean, headcount's going to be, for the most part, most businesses, 80% of your expense. And so the difference between the 80 and the 20% is where we're really having a lot of questions. And now you have to take into account a number of variables, but that's where I would start. I would look for the key drivers of the business, the material pieces of the business that actually move the needle. It's like sort of when you negotiate a job offer with somebody and it's a difference of $10,000, but if you don't get them, you lose your ability to execute on a key product objective. And so by what are we really talking about, that difference? By getting that product feature in earlier, you can get it into market faster, which gets your sales faster. So those removing those little decisions and focusing on the big decisions is the key piece.
Makes sense. So let's talk about the next step in FP&A, going back to our diagram here. After we do this long-range plan, the 2-year look back, the 5-year look forward, that is what enables us to do the rest of our planning, which is more short-term. The annual operating plan, you might also think of this as a budget. And here on this diagram, we've listed people, capital, other resources. You both have alluded to this in the previous section. We need to really figure out what are we going to do with our biggest assets. And in a lot of businesses these days, it's people, because we're dealing with intangibles in many cases. So, how do we allocate people? When do we hire them? When do we not? John, I'm going to go back to you here on this one. Annual operating plans. When do we do these? What do they look like? What are your tips for businesses to optimize this? This is a little different because most businesses, I think, are doing budgeting. If you reach a certain point, you got to have a budget, but not necessarily effective. They're not necessarily all effective.
Yeah, well, there are budgets and there are budgets, and most budgets are, it's a conceptual framework. It's your plan for some coming period of time. I prefer to think in terms of what we call a rolling forecast, which you can freeze at any point in time and call that your budget. It's still a view of the entity. It's just continually updated every month, because unfortunately budgets tend to be static. So you might put in some massive convulsive effort once a year and give birth to this thing in December or January of the year, and then you're comparing yourself to it every month and quarter. But the second that thing hits, life takes over and things start changing. So one thing to remember about a budget is it's never going to be right, and updating it frequently will actually get you better at creating that forecast. Like just forecasting repeatedly makes you better at forecasting, understanding the ups and downs and what may or may not hit your business. If you're only doing that once a year in an annual budget cycle, we find that the rate of improvement of actually foreseeing your future tends to be worse than if you're updating every month. So that frequency is critical. And of course, it's as much about communication and internal education as it is about the mechanics of the model. It's about rallying everyone around it. You really need to understand all of your business drivers. So there is a process. If you're doing a once a year budget, it takes most entities a number of months to do that. I would say between 3 and 4 is probably pretty typical. If you're doing a rolling forecast, then it might just take a number of days to do, a forecast turn every month. You get much, much quicker at it. It almost takes less time to do a rolling forecast monthly than it does to do a once a year budget cycle, because you're not just picking something up once a year that's so massive. So there's definitely a lot that goes into it, but the benefits are just very clear on their face. Yeah, that's kind of the size and scale of it.
So John, I'm going to play devil's advocate here.
Mm-hmm.
The annual budget process, I think, can be notorious in some businesses. I've been a part of this in one that was kind of dysfunctional, and it's not fun, right? People don't really enjoy it. They don't get a lot of value out of it. When it's not done properly, it just becomes this sort of almost a compliance exercise.
Yep.
People game the system, that sort of thing. And then you're telling me now, wait, you want me to do that more than once a year? And this is something that can take 3 to 4 months to put together. So like, how do you reconcile that? Like, what are you doing differently with rolling forecasts that make it not a painful process that we might be used to in many cases?
Yeah, it's actually almost like the monthly close in reverse. If you only closed your books once a year, there's an avalanche of things that have to be covered. Oh, I can't remember, that was 9 months ago. There's just so much that you're trying to, bite off at one time. What's that joke? What's the best way to eat an elephant? One bite at a time. The rolling forecast allows you to take smaller bites and you're learning as you go. And what you find is when you're doing something more frequently, you're getting better at all of the mechanics, and especially if you're using better tools, which is a piece of this not to be undersold. but it also gets folks more into and invested in the process. So you're not just coming to someone once a year and say, hey, guess what's happening, 12 months from now, in isolation from the last time we did it last year. It's okay, well, last month, here's what happened. And, let's figure out what deals, got pushed out, and things are much closer to you in general. And, you're just exercising those muscles. So your people get better, your processes and your technology, when they're all coming together to support this, it honestly is faster, easier, and the outcomes, it's just better. And when you're seeing the results of your forecasting every month, and the best forecasting looks back and compares itself to prior forecasts, you can see that your variances are tightening, tightening, tightening. It's actually very gratifying, and people get better at it. It's like any exercise.
How about you, Evan? Like, what's the difference in your mind between a annual budget and a rolling forecast, and how have you put that into practice?
I think about it very similarly here to John, though I'll use an analogy that of, every business is going to have some sort of overhead to it. It's just whether or not that overhead has reached a point of pain where you have to resolve it, right? And so when you do an annual budgeting process or an annual plan, that's a very painful experience the first go of it. And so when you start doing it on a more frequent basis, it becomes more like breathing, right? And in between those periods where you're updating the forecast, you can make efficiency improvements in the business, especially as you scale. And some things can be done through product, some things can be done through process, and some things can be done through people. And you have to assess what those needs are. And so this is where a partnership between finance and accounting comes in hand, because the way that you're doing your general ledger of bookkeeping is the foundation to how you're going to be doing your forecast. So you might change how you do some of your general ledger of bookkeeping in order to accommodate forecasting in a much more simpler and faster and easier way. And so you have to look for those and identify and execute those processes as you go, or continue to fill it through people. And so that's how I think about it.
So you mentioned reporting. Let's talk about that process. Let's imagine that we've done this for the first time. Say, well, this is actually good timing, right? Because we're in September. This is when a lot of businesses start to think about what's going to happen next year. At least hopefully you're thinking about it now and not in December. So you've got some time. You've got months to do this if you've never done it before. You build out your long range plan. I think September is a good time to really update that, right? And then once we've done that, maybe October, November, we're working on our 12-month rolling forecast or budget, whatever we want to call it, that annual operating plan. And we get that in a pretty good state, and we're happy with it. And we lock it, and we say that's going to be our 12-month budget. If it changes, okay, we'll update if things change on the ground, but let's go with this for now. So then we get to January, and end of January, we close the books, we run our reports, and the most important report in the FP&A world is that plan versus actuals, or budget versus actuals report. We look at how do we do this month or this quarter perhaps, and what was our plan, and what are the variances in that. And this is where we start to understand the value of a rolling forecast, because with the annual budget, right, as we progress through the year, those variances might grow and grow and grow until the budget's just, well, there's certain words I can't use on this webinar, but you understand, right? The budget is in a state where we can't really use it anymore. But if we are updating it periodically and updating our rolling forecast and making that our new budget, then we can actually change what we're doing throughout the year and stay on track. So let's talk about some reporting best practices, right? When we're doing this as part of an FP&A process and not just in isolation, John, what are some reporting best practices? How do we do this so that we are hitting our goals, staying on budget, getting where we want to go?
Yeah, well, the first is not to be inflexible. So your point about how, a couple months out, your budget is all but, useless. if you're not updating a forecast and continuing to compare to budget. Because at what point when reality diverges from your wonderful plan, do you actually change your behavior? Like, would you not change in the face of COVID or differences in consumer activity or whatever it is that drives your business? And of course you want to. You don't want to be dogmatic. So you want to use your reporting to help you, understand the why of things, to help you change the way you're approaching the business, because you're always trying to get better. And it's funny, a lot of sort of what I would call basic or gap-based reporting is based on a chart of accounts that was created at some point in the past, typically by some bookkeeper somewhere. And a lot of companies will do these reporting packages month after month, and you show it to the CEO and the senior execs, and like, okay, yeah, great. Onward we go. And what is not giving is a sense of why, because a gap-based chart of accounts doesn't say why. It's like, oh, well, SG&A expenses were off 8%. Like, what does that mean? And what am I going to do? Is that good, bad, otherwise? And good reporting helps you get to the why. And that's usually why we go to what we call advanced reporting or non-GAAP or beyond GAAP reporting, where you can see things like customer acquisition cost. Oh, well, okay, we might have been less profitable last month or last quarter because our cost of acquiring our typical customer was, up here instead of down here as we budgeted. Now what are we going to do? Okay, well, you spin your forecast with better understanding of your customer acquisition cost, and there are just scores and scores of things like that. Why are our operating expenses so high? Oh, it's because that human factor. We had to hire more people to get a product launched, and all of these things get to the why. So good reporting sets up, delivers to some extent a better understanding of why, and also it sets up the conversation and also helps prepare you for analysis, because reporting tends to be kind of higher level. We all want it to be automated, we want it to be rather quick and painless, and to set us in the right direction. So great reporting does all of those things and helps you get to the better forecast, helps you aim the guns at the analysis you need to do to improve some piece of your economics, etc. So that's what great reporting can help you do.
Yeah, I love this item here, John. The chart of accounts built years ago by your first accountant. When I was doing bookkeeping, I would often inherit a chart of accounts from a well-meaning accountant or CPA, and I didn't quite feel like I had the experience to say no to using that. But now in retrospect, I realized most of those charts of accounts were terrible when it came to actually helping figure out what's going on with the business. We'd have a single transaction in there every month, and it would be like immaterial, and yet we have so many of those accounts in our reports to the point where our P&L is 3 pages long. And I very quickly, well, it took me a long time to realize that I need to have as few accounts as possible if I want to manage this effectively, and I need to be collapsing a lot of stuff into a single account.
Bad reporting, Blake, is full of distractions. Yeah. And you just absolutely want to drive yourself away from distractions and help determine the things that are going to help you run your entity profitably, sustainably, get to wherever you're going, et cetera. That's what good reporting does. And you do need to have this separation. You just can't be beholden to GAAP all the time for that, and you don't need to be.
So Evan, one of the reports that we feature at Giraffe is the executive summary report, where it's actually a challenge to build it, because a lot of times when you're starting with a company with 200 accounts in the chart of accounts or more, you have to condense it down to a single page, right? And that's a good exercise to do. So, do you have any recommendations for folks who are going through that process? And you don't have to stick to just that, just your general reporting best practices.
Well, I know what you're asking me. You're asking me to explain my natural chart of accounts and planning chart of accounts and financial statement line items. So when you're doing all these reporting that we're talking about here that John's outlined very nicely, let's not forget that some of the people who are consuming this information have no inclination of how to do general ledger accounting, bookkeeping, forecasting, or anything. However, they need to understand what's going on in the business, and so you have to be able to communicate it in a simple way that the average business user can certainly understand and comprehend what's going on and help drive the business along with you. That's one of the parts of leadership. But you still need to reconcile between that individual and the individual who's doing the day-to-day bookkeeping. And so in your accounting system, you're going to need to have all your natural chart of accounts and some level of detail there in order to provide the foundation to run the business. But then when you get into financial forecasting, you're going to do like planning chart of accounts, where you might need to break out accounts in a different kind of way in order to accommodate a different basis of generating a forecast. And then you get into financial statement line item reporting, which is where you roll up and consolidate your planning chart of accounts. So it's even a higher degree. So an example could be fully burdened headcount wages. So a business user who's an investor in the company, who is not really interested in anything outside of the outcome of the business, doesn't know accounting, they just want to see what's the total cost of all your employee headcount. But then underneath that, you might have planning accounts that breaks out in super, you might have planning accounts that just has a very high level. Here's my assumption of travel and entertainment. It's a percentage of the historical average. But then in your natural chart of accounts, you're going to have the detail of meals and entertainment, accommodations, travel, because that's what's going to connect into your travel and entertainment policy and your expense reporting policy, like an Expensify. You need all those accounts to hit. But at the end of the day, what you're really trying to get to when you're having a conversation about the business is what's the total cost of our employees, which could be a collection of a variety of different accounts. So that to me is like that simple reporting that's not GAAP reporting per se, but allows for people to understand and make decisions about the business.
And then this last bullet point item, KPIs. What are your KPIs, key performance indicators? And then non-financial info. This is really important because, like John said, often the non-financial information is just as important, if not more important, to figuring out what to do than the financial information. So, Evan, if you're producing a line on your executive summary report that is fully burdened headcount, wages, shouldn't you also have headcount on there,
yeah,
right? And then actually be able to figure out what is it per employee, and maybe by department, that sort of thing. That can be really, really helpful. And John has generously provided some examples of dashboards, and this takes us into our next section in the analysis, which is visualizing the data, making it actually digestible for non-financial folks, or even financial folks such as me, who might be too lazy to read through the entire set of financial statements and just want it presented very cleanly in a visual way. So John, do you have any favorite KPIs, top non-financial metrics that you like to highlight for clients?
Yeah, well, so first off, we should note that KPIs vary by industry and potentially company, pardon me, although they tend to be, the sort of key ones tend to be similar across industries because a lot of learnings are the same. So I mentioned customer acquisition cost earlier. That's an interesting one because it helps you understand how much it's going to cost you to get your next customer. And then if you understand your average customer size, that's another key element. So what's your average, booking per customer? And then that leads to lifetime value per customer. So, how long will you keep a customer and they'll be paying you before you lose them? These aren't meaningful for every business, that's for sure. But for some businesses, they really tell you an awful lot. Like if you can acquire your next customer for less than their sort of discounted cash flow value of what they're going to be to you lifetime, then you should pour an infinite amount of money into this business because you're going to be profitable doing that on a cash basis, inflation weighted, all that fun stuff, which I won't bore you with. But there are certain highly insightful things. So imagine you're running, Google ads campaigns and you sell a $200 widget, which costs you $50 to build and deliver. So you make, other than marketing, $150 every time you sell a widget, and it costs you $50 to market and sell that widget. So you clear $100 conceptually. I'm really being grossly high level here. You should pour the GDP of the country into that product until you close that gap and you're no longer making money. Okay. And it only took you a couple of KPIs, none of which came off your P&L, to figure out that that's the thing you should be doing. So KPIs, should just be deeply insightful and help you drive decision making. That's kind of the high level of it.
Yeah, and unfortunately, in traditional financial statements, we don't find them. We just find the
They ain't
money,
there.
the numbers, right? Yeah, and that's but those, cost to acquire a customer, average contract value. Evan, you could probably rattle off like 100 of these. Those are all super important to figuring out where we want to go, how we get there, whether or not we can get there, how much money we can spend on acquiring these customers and growing, right? So dashboards, trended KPIs, very, very important to analyzing where we went, where we've been, where we're going, all that sort of thing. So let's talk a little bit more about analysis. And actually, we can just list out some more KPIs. I think this is really helpful for folks to understand how we can use non-financial information in planning and how it's just as important as the finance stuff. A little hard to hear as an accountant that, all that work that I did to put together the trial balance is only like a third of the picture. But we have to be, realistic about this. And it's kind of fun actually as an accountant to know this, because now I can go out and I can find all the other data that I am not looking at right now, and I can be a part of that conversation. And now all of a sudden the folks in operations are excited to talk to me because I'm giving them data that they really need to do better. So
yeah, it works best when finance and accounting are working hand in hand. That's what you see at highest performing companies. And then you always get invited to the table, which Blake, I think is, the point you were making there. You want to be invited to the table by your business partners.
Right. Yeah. And it just makes what we do actually a lot more interesting, right? A lot more meaningful. Mm-hmm. So here is a list of KPIs, ideas, where to start, places to think about. The marketing ones, as somebody in marketing these days, I really enjoy, and marketing has become a very analytical type of enterprise. And often marketing folks don't have the analytical background with numbers to really get a handle on this stuff. So it's probably an area that we can help draw attention to. MQLs and SQLs, those are different types of leads. Funnel conversion rates, right? Those percentages, tracking that, reporting on that. That could be something that we do in finance, at least collaborating with marketing to report on that to the C-suite every month or every quarter. We mentioned customer acquisition cost, lifetime value of a customer, so important. How about these other ones? Guys, what is exciting for you, Evan or John?
I always get excited over the working capital metrics, because working capital is, to me, that's the point of a business, right? Is you're taking cash and you're converting it into something and you're selling it. And that's like a very important thing to understand in terms of the underlying business and what is happening. And to add on to the, KPIs are definitely a heuristic around the business and how it's doing, but it also helps you identify from a forecasting point of view what the drivers of the business are. So if you have KPIs that swing wildly or are stable, those are going to inform different ways that you need to think about forecasting the business. And so as you scrape into these KPIs, you'll see which ones are the most meaningful to your business. I feel like sometimes we could potentially become overwhelmed with too many KPIs when it's maybe like 3 or 4 that are really the ones that are moving the business. And that could change over the life of that business from cradle to grave. And so, in the early days of a company, it's going to be forward-looking cash burn so that you can get your cash runway, not your retrospective cash burn. And that's the whole point of an operating plan in the future, because it doesn't matter what you burned last month. It matters what you think you're going to burn next month. You have to be able to think about what you're going to burn next month in order to do that. But then as you get up into the scale and you start getting into, say, manufacturing business, you might have economies of scale start to enter the business where you have step down in prices, and you get better margin and profitability into the business. And so those are the things that I think about when I think about KPIs.
There are so many. It really just depends on the business. One that is almost universal for for-profit entities that are growth entities is EBITDA. That's earning before interest, taxes, depreciation, and amortization. I know that's a mouthful. EBITDA is a sort of very shorthand for a company's ability to create cash with some assumptions. And that tends to be a key basis for sales multiples, for valuations. So if you're planning on selling your company at X point in time, driving improvement in EBITDA is going to drive improvement in your entity's value and therefore presumably your exit. Now, if it's on the not-for-profit side, it would be something like cost to serve. What is it you do as a service, and then what's your cost to serve each person or whatever it is? What's your measurement of who you're serving and how, and what are the economics around that? Because you're not trying to sell a business, you're trying to serve more constituents, right, and benefit more people. So that's why I kind of noted up front, KPIs, they really vary by industry, and it's a very personalized thing, but it's all about getting to that why so you can do better.
And that takes us full circle, John. Thank you for that. Because thinking about EBITDA, for example, and what we want it to be so we can sell our business at a multiple, well, isn't that the reason we did that whole long range plan in the first place? Well, ideally,
it's so perfect that this is a cycle, honestly, because every ounce of reporting that you do leads to things that you recognize you need to analyze. Every bit of analysis you do leads to better assumptions in your forecast, and round it goes. And with every revolution of the wheel, you get better because you understand your economics that much more deeply. You understand through great reporting that you're impacting your economics. Like, it's not to nerd out on finance here, but it's actually fun, and it makes you yourself and your organization understand the value of these things when you actually see things trending in a way that you kind of planned, and made happen. It's like, oh my gosh, by focusing on our accounts receivable challenges, we've reduced our AR balances and our cash is going up, and now we can invest more in marketing and sales. And it's like, voila, this whole thing is kind of working. This is business with a capital B. If you got all of this stuff going here, you are going to be running a more effective, more impactful, more valuable organization. There's just no doubt about it.
Yeah, I get so excited because, as with so many things in this era, we are speeding up an existing process that's been annual, and now we're just doing it more frequently and more effectively. And by doing that, we are able to be more agile, and that's super important. We can't wait a whole year to change our plan. As we saw with COVID, the companies that were able to change their business models and retune within a quarter were able to survive and succeed. Those that did not and just said, oh, things will go back to normal in 6 weeks, they struggled.
Yeah, and what business does nothing except on an annual basis? Like, you would, if you were a tech company, do you only update your software once a year? Okay, well, your competition is updating monthly and changing based on what they see they need to do. So really, I find that finance and people's application of finance is really following the natural evolution of business, which is cycles are getting faster. You've got to be way faster, in order to respond and stay on top of your competition and reach your goals.
So where do we go from here, John? How can our attendees, those watching, get started modernizing their FP&A process?
Yeah, well, first off, introspection, ask yourself, what have we got? What are we doing? Are we running this business from our gut? Would I like to have, would it be valuable to have better insight into our core economics? And then you start, if the answer to that is no, congratulations. If the answer to that is yes, then there's a process you can go through, which really starts with kind of taking an inventory of your capabilities, people, process, technology. where do we stand, and then comparing that, kind of laying that next to, well, where do we want to be? And both Giraffe and Armanino can be helpful in those instances. And we actually have a wonderful process where you can do a completely free, no strings attached, anything workshop with you to discuss those things and give you some perspective. And yes, of course, it's partially self-serving if you want to work with either or both of us going forward, and we do work together, which is wonderful. But it would really be valuable just for yourself and your own education and edification to get a better sense of where you are. And if all we've done is helped you get to a deeper understanding of the art and science of finance and how you can use them to better your organization's results, fantastic. That's a win. Okay, even if we never do business. So that's part of the no strings attached, and we'll be thrilled if that's the case. And if we can help you actually impact some of these things and get to some of those goals faster, or with a higher valuation, or serving more constituency, that's also awesome. So, this is a next step, and you can see the email there for outreach, and we'd love to chat with you.
Reach out to experts at armaninollp.com if you're interested in talking to John, learning more. Evan, we are very excited to partner with Armanino because they have the experts. Giraffe is building the software, and I don't know if you really discussed it that much on this webinar, but you are leading our services and support team. You are deeply engaged in supporting our accounting firm partners. Can you speak briefly in the few minutes that we have left to how we as a platform for FP&A help make this cycle possible?
Yeah, it's a lot to do in just a couple of minutes, Blake. Yeah, we here at Giraffe, we enjoy a relationship with CPA.com, and in that relationship, we're really working with the entire industry, and very lucky to be working with Armanino in terms of helping bring this type of tool to market. It's amazing how many people don't know it exists. This type of product exists for Fortune 500 companies with a $100,000 entry fee and a 6-month implementation process, and it's way beyond the scope of what a small business or nonprofit is likely going to need. And so by partnering with firms like Armanino and being able to accelerate that time to value for their clients and the ability to get those advisory services and really begin to scale up and really just help the small business community is really exciting. And so it's been great working with all the firms and Armanino in terms of helping bring that to market and really sort of introduce a new technology and a new way of thinking about your business. So thanks for joining everyone today.
Yeah, really appreciate everyone being here. And that brings us close to the top of the hour. I don't believe we have any questions, but if you do have one, you can go ahead and type that in to GoToWebinar, and we'll be happy to answer it. I'll hand things back to Nyla to wrap it up.
Great. Thank you guys for joining us today. I hope you enjoyed the session. As a reminder, I'm getting a few pings. You will be receiving the presentation and link to the recording within 48 hours. The contact information for all our speakers will be in a deck. So if you have any questions, feel free to send it to them. And again, have a great rest of your day. Thank you.
Thanks, everyone.